Hey folks, Tony Christensen here, one of the co-founders of Statera Wealth Management. I hope you all had a fantastic Christmas and New Year, and by the time you get this video, it'll probably be early February. But ultimately, we hope that 2026 is starting out with a bang and that there's a lot of exciting things on your calendars for 2026. In this video, we're going to go through kind of what did 2025 look like, what are some of the things that we can look at moving into 2026, etc. But I find it interesting, at the end of the day, this little guy, your cell phone, has more information on it than you can, possibly imagine, right? There's a never-ending supply of information on this thing. And I think it's hard to know how to sift through all the noise and to know what actually matters and what doesn't matter. And so one of the things we're going to do in this video is we're just going to sift through all of the data out there, compile them, consolidate, and then give you some key themes. So those are some of the things we're going to do on this. Now, I do have to show you my disclosures for my compliance team, and that probably should do the trick. And ultimately, here's what we're going to cover. So what happened in 2025? What are some of the potential outcomes in 2026, including the threats and the opportunities? And then ultimately, what does this all mean to you, your investments, and your plan? In other words, why do we even care? So we're going to go through all of these things. Now, let's start with what did 2025 bring? Now, I would say that 2025 was one of those years that you just almost everything did fantastic. Now, as you can see, the S&P 500 did, this is the price return, did about 16%. The Dow did about 13%. The NASDAQ about 20%. Inflation hung in there and stayed fairly stable at about 2.7%. And then here's some of the new ones, though, that we haven't talked about as a positive. You had international developed equity that did 31%, depending on the ETF that you follow. And then you had emerging markets that did about 33%. Those two categories for many, many years have really underperformed and struggled. And so we're excited that they are coming back in the game and they are helping with our diversification mix in boosting returns. Another one that was very interesting in 2025 is that gold. Gold came in with just a banner year at 64%, and there's a lot of reasons that we could identify why gold has been such a good hedge and why it's been so great. We don't have a ton of time for that in this presentation. And then the other one is just the aggregate bond index. That's really struggled the last few years, especially since about the peak of when we started having end of 2021, we started seeing interest rates start ramping up. Well, when that happened, bonds have really struggled since then. So 2022, 3, 4, finally in 2025, we're starting to see the bond index do well. A lot of that is driven because interest rates have been coming down in 2025, which drove the price of your bond up. And then you stack on the yield, and that's where you get about that 7.3%. So it was actually a pretty decent year for the bond index. Now, some of the things that were not as positive, Bitcoin, who was kind of like our big winner when we did this video last year, it was down about 6.5% in 2025. Real estate continues to struggle, and this is just based on a Vanguard ETF called VNQ, but it essentially returned with yield, so with the income, about 3.3%, and ultimately real estate's had a pretty rough run, and it's kind of correlated with interest rates. As interest rates ramped up, real estate and real estate fund managers, it's been really difficult for them to manage that interest cost on real estate. And then you stack in the fact that inflation has continued to show its head in different areas. I don't know about you, but my home insurance on my home in the last 12 months went up, gosh, I don't even know, maybe 60%. It was a ton. Well, as you can imagine, real estate as an investment has been experiencing those increases, and so it's really been hurting its ability to produce a good return. And then the other one that I would say is probably not so positive as money market rates have really come down. I would say as of today, and we're at the end of January, we're seeing that most money market rates are somewhere in that 3 to 4% range on average. And so, whereas, gosh, not that long ago, you were probably getting north of 5%. And so that's a not so positive in that in order to make money on your money in the bank, you just can't make as much as you did before. So, folks, one of the great parts about being completely independent is we don't have any product strategy, etc., that we have to sell, right? We don't have a company that holds us captive. What's so great about that, though, is we can still take the information that all of these big investment companies and banks have, and so what we did is here's some of the names that we've been reviewing their information: Goldman Sachs, BlackRock, Charles Schwab, Idea Farm, Vanguard, JP Morgan. Well, all of these have their own white papers and their own view of what we can expect in 2026. And as you can imagine, if we got into the weeds and I showed you some of the stuff that we've been reading, you'd probably fall asleep and tune out. But one thing that we did do, though, is we took all that information and we tried to narrow it down to just a couple key points that were kind of consistent themes throughout all of these white papers. And so here is two key themes and takeaways as we have digested just all of this information. Number one, earnings-driven growth supported by AI or artificial intelligence. Now, what does that even mean? What that means is that up to this point in the market, the excitement around AI has been driving the prices higher, higher, higher. And so as we look forward, the future market is going to more than likely, what these reports suggest is that the future market will more heavily depend on the company actually producing profits because of AI and not just the hype and the excitement. And so that will be the theme of this year. With all the hype and the excitement and all of the capital expenditures that these companies, they're investing billions and trillions of dollars into their infrastructure to help bring AI into their core growth model. And so we're going to be moving from, yay, this is going to be amazing, this is going to just change our world, to, okay, is it actually changing the world? What is happening? Is it actually moving the needle for these companies? That will be a big question mark as we move into 2026. The other one that really came through between all those white papers and those reports was it's not a bad idea to start considering the fact that maybe U.S. mega cap stocks are not the only place to be for true growth. And so all this really means, you guys, is that diversification is back, and you might be carrying more risk in your mega cap stocks than maybe you knew before. So let's talk through some of those things. Before we do, this is something that we go through every year. And we just like to, for those banks or investment companies that are willing to put out their prediction for 2026 returns of the S&P 500, this is what we could find online. Goldman Sachs, 10 to 12. JP Morgan, 8 to 10. Fundstrat, 11 to 12. Dutch Bank, 16 to 21. Oppenheimer, 17 to 18. Bank of America, 4. Now, like we said in the past, you have to be really careful when you're seeing these types of predictions. There's only one thing that we are very, very sure on, and that is that everyone will be wrong to some degree, right? So why even bring them up? We bring them up because we want to have a discussion with especially our clients to say, be careful what you read. If we were to go back and we were to look at, let's say, the end of 2007 and what the 2008 predictions were for many of these large banks, you would find that they were all very positive. And yet what happened? What happened in 2008, right? We had the Great Recession, and none of these guys could have predicted that, and they didn't predict it. And so as we're looking at what 2026 will bring, take it with a grain of salt and just use it. Just put it in as an arrow in your quiver as you're just thinking through how things may play out in 2026. At the same time, man, these are some big numbers, and we'll see. We'll see what 2026 actually has ahead of us. Now, what are some of the threats? And we kind of already talked about this. That first one on the far left, can AI produce actual profits? Ultimately, we're just seeing, can these companies who have been putting tons of money in, can that actually make the difference in producing profits for those companies? If it cannot, a lot of the stock price for these companies is already priced in. And so if they experience the unfortunate reality that it's not doing what they anticipated, it could really drive the values of those companies down very quickly. So we got to be careful with that. We're in the same space we were last year. We still have high stock valuations. I was reading some reports from a variety of sources, and it was interesting because a lot of people, there's a lot of arguments out there that suggest that high stock valuations are okay. And one of the consistent themes is that they're not as high as you may think, or those high stock valuations can go higher or maintain. And one of the things that they reference is just the fact that all the stimulus money has entered into an economy over the last 5 years, and that's never happened before. And so it's a reasonable thing to think that stock valuations are just going to be high. We'll see how that plays out. I still think it's something that we need to be thinking about as we look to what does 2026 bring. I think probably the biggest headline risk out there right now is obviously political uncertainty, tariffs, deregulation, policy shifts. You never know. You never know what you're going to read on the news from one day to the next, and you never know how that's going to impact the economy, the markets, etc. I think this is a very big risk, and it was the same last year. It was a very, very big risk, but I feel like it feels bigger this year, especially as this year has already started with all of the craziness that we're seeing on the news. I also think it's very difficult. I'm one of those really level-headed people, and I try to understand both sides of every spectrum. And I think right now it's so difficult. It's so difficult to know what we're actually dealing with. And so I think that's a big threat in 2026. And then this also showed up last year as well. The Magnificent Seven, and if you don't know, that's the 7 large U.S. mega cap stocks, right? Such as Apple and Meta, Microsoft, etc. Those big Magnificent Seven stocks, they make up about 35% of the S&P 500. So a lot of people, they will, we've had this question in the past, Tony, hey, does it make sense? Should we buy some more stocks that are kind of leading the charge in AI, or should we buy more of Apple or more of Tesla, etc.? The truth is, if you just own the S&P 500, about 35% of your holding relies on those 7 stocks. And so we have this concentration risk, and it's going to be a risk again as we move into 2026. Now, some of the opportunities, fixed income, so kind of that bond exposure, fixed income, because rates have come down, it's allowed for fixed income to, they've had some price appreciation, and it's likely that may happen again in 2026. And then you combine that with the yield is still decent that fixed income is producing. So it's not a bad place, although you probably need to be a little careful when it comes to maturities, and I won't get into that here. So you don't want to be too long on your maturities. But another one is artificial intelligence. Now, artificial intelligence is the very thing that I just shared as a threat on the 2026 slide. And so it goes both ways, right? AI could be another big pusher in 2026. We just hope that it's actually moving the needle for profits now. Now we want to see how is it actually getting implemented into where it actually makes a difference on earnings. So, and then this other one, international exposure, it looks to have more excitement moving forward than it has for the past decade. And there's a lot of reasons for that, but ultimately this is another one of those potential opportunities in 2026. Now, another thing to think about, you can still get, for those of you that are sitting on a lot of cash, you can still make in that, call it 4% plus range with certain fixed income types of investments. And so that would probably be the other thing, is like you can still make a little bit of money on your cash, at least as of right now. I don't know what that'll look like at the end of 2026. And so maybe, it may not be a bad idea to just consider, maybe you're looking at like a 1-year CD that might pay you better than a money market rate. It may not be a bad idea to consider something like that for that excess cash in the bank. Now, what does this all mean to me? What does this all mean to you? Now, as you can see in the background, this is a picture of a freeway. And so I have 3 little kids, and Disneyland it's an annual trip that we go on. And so in the fall, we were headed out to California. We live in southern Utah. And one of the things that I find fascinating every time I get on the freeway is that when it starts to get really busy, you start to second guess which lane you want to be in. And I don't care, it's crazy. This happens to me every time. If we were to follow like financial or driving theory, it probably is the most reasonable to stay in the far left lane when we have a long time until our destination. It's probably the most likely that we'll get to our destination the quickest by staying in that far left lane. Yet, what do? Ooh, there might be an opening here. So you move in, and then if you're me, you pay attention to that car that was behind you, because now you're just very curious. Did I make the right decision? Did I not? And now we're like going back and forth, and I'm watching this car, and then all of a sudden I see that car has really gained some steam on me. And so what do? I look to get back in the fast lane, and then all of a sudden the fast lane really slows down. And anyway, it is just such a disaster when it comes to deciding what lane to be in, when, and why. And because it's just easy to find yourself thinking that there's a better lane than the one that you're in. And so it's very similar with your finances and with your plan. At the end of the day, it's so easy to be persuaded to jump ship, to alter your plan, to alter course as you get fed more and more data. That data can make us abandon our plan. And so what does all this information really mean? Really, all the biggest thing that I would hope people would take away is that we need to stick to our plan. We need to stick to our plan. We need to understand the overall framework of what we're trying to do and what the end goal and result is. Now, one of the things to think about is, what does your fiscal house look like? Now, a fiscal house has 3 components. Your fiscal house is going to be made up of money that's in the foundation, which is all about safety. You're going to have money in the walls, which is all about producing income. And then you're going to have money in the roof, which is all about that growth potential. Now, the older we get, the more we find ourselves moving money to the walls and the foundation, right? And the younger we are, the more we would find ourselves having a lot more in the roof. Ultimately, this fiscal house, although it needs to be constantly massaged and updated and altered, once it's created, you don't want to make these massive shifts because of news, because of what Goldman Sachs just came out in a report with, right? All of those things, you have to be really, really careful. And so if we could say one thing, it would be very careful about making rash decisions. I think 2026 is going to bring a lot of volatility. I think the geopolitical risk that we're dealing with right now alone, this year, it could just produce big swings. But go back to your fiscal house and ask yourself, well, okay, if things are moving, well, do I have enough money that's safe? Great. Do I have enough income to support my lifestyle? Great. Well, then it's likely that you could probably hang in there and keep your money invested in the growth, because long term, markets tend to reward those who can hang in there. And so just really always constantly ask yourself, do I have the proper amounts in the foundation, the walls, and in the roof? And if you're unfamiliar, reach out to your advisor on our team, and let's just have a rediscussion and make sure you understand what your fiscal house looks like, because I think that'll bring some peace when the inevitable craziness of the news and the unknowns of market movement will occur this year. We have had incredible growth the last few years. It is very likely and very reasonable to assume that in 2026 we are going to see some big swings. And so you just got to be ready for it. And part of being ready for that is being very aware and clear of what your plan is and what your fiscal house looks like. One of the things I also wanted to bring up from a company standpoint, we're excited. We've had a couple hires in the last 12 months. This is the team as it currently stands minus our newest hire. His name is Daniel, and many of you will probably hear from him. But I just wanted to reiterate something. One of the things that really brings us a lot of joy is when we hear that money has essentially faded to the background and life has come to the front. And what does that mean? It kind of goes back to what this slide suggests, or what it says is our purpose, which is to help people disconnect from the concerns of money so they can focus on the most important things in life. When we find that our clients are living a great life and they are not attached to watching the ups and downs of the market every day, we find that they have more fulfillment in life, and they just do more things. We just changed our tagline to create the plan, live the adventure. And we love the idea. We love the idea of living an adventure. We do, because it brings uncertainty, it brings fun, it brings excitement. But in order to do that, in order to live that adventure, you have to create the plan. That plan is what allows you to live that adventure. And so we're committed on a lot of fronts. There's so many changes in our world. You have new tax laws. You have the one big beautiful bill. We have some new things when it deals. You may have, if you're over 50 and you meet a certain criteria for catch-up contributions, there's a change in how you can put money into your catch-up contributions. Well, all of this information is hitting us on our advisory team just constantly. And so we have really tried to say, how can we make sure that we are covering, turning over every stone for the families that we serve. And so we're bringing on more people, and that whole goal is just trying to help you guys live a better life. And so more than anything, folks, we want you to know how much we appreciate you, how much we appreciate your trust in me and our team. The firm wouldn't exist without you. The firm wouldn't exist without you over time, slowly letting go and letting us really step in and take a lot of this stuff off your plate. And so to finish up, I can't express enough how much our team just appreciates you. We appreciate your example to us. We appreciate you sharing stories with us. One of our favorite things is when someone shares a story, it goes to the whole team and we all get to see it, and it helps us remember why we do what we do. And so as 2026 comes, folks, we just want you to know how much we appreciate you. We hope that 2026 brings really fun adventures. We hope it brings great memories. And ultimately, if you have any questions about what I've gone through here, please reach out to us, get on our calendar, and we'd love to help in any way we can. And thank you so much.